Hey traders, this is Jeff from ZenTrader.ca with a market update and a sector update. And basically the bulk of this video is going to be explaining to you why there's no need to be short. I see no signs that this market is weakening. I see a lot of rotation, and let's get right to the chart. So here we have a NASDAQ composite, a 60-minute chart. This is when my timing signal went bullish. It's been spending pretty much the last 6 weeks just consolidating and slowly moving up, so we're not anywhere near overbought on this. This looks like it's just getting ready to continue higher. Dow 60-minute, this is quite bullish, not overbought, but more overbought than the NASDAQ, and yet if you look at all of this together, this is a really powerful move. And it's not to the vertical. It's not the vertical stage yet, so I still think there's more room here to go. The TSX, this has not done a whole lot. This is when my timing signal went bullish. This is really getting held back by gold, but still, it's still trending between 80 and 40. And the RSI has not broken down yet, so let's continue to monitor this. And this is the weakest of the three. But the long-term aspect of the timing signal for the TSX remains firmly up. So I'm just going to quickly go through I went through all of my sector charts tonight, and basically you've got real estate, pipelines, metals, and tobacco, which are weak, and everything else is strong, pretty much. And not just strong that they're overbought and a correction is imminent, but strong that many of them have looks like they're getting ready to accelerate to the upside. So here are containers and packaging. We have an inverse head and shoulders pattern forming here. Even though this is a pretty obvious pattern, there's really two things to watch here. If it does break out, then this has a lot of room to go. This measures about 25 points here, so this could easily make it to 290. The other thing is if it goes up and it fails, then the move down will be really swift. But other than you've got an RSI which has been trending between 80 and 40. This is a bullish trend here. Nothing suggests that this is going to end right now. Computer hardware index led by Apple. This chart really mirrors the chart of Apple, and you've got a inverse head and shoulders here that is played out, measured, and it still continues to overcome the different resistance levels. I haven't even marked the next one. It would probably be right around 1250, 1275. Now I don't expect this to just zoom up here. I expect more of what it's been doing pretty much since June. It's just been moving up, pulling back, moving up, consolidating. This is very bullish. The life insurance index, extremely strong. There's no reason to think that this is going to stop. Now obviously I don't think that it can continue in this way. It's going to need to consolidate, but just because we're at high levels doesn't mean that we have to automatically correct. Hotels, there's really not much to say here. Who would have thought hotels would be such the leader that it is? The internet, this is a lot to do with Google. I believe that this is the gap off of Google's earnings. This has been consolidating in a range, and it looks like it's getting ready to push higher. Apparels, retailers, strong chart. Semis, strong chart. Just time and time again, as I was going through my sector charts, it just really reaffirms that being long right now is the only trade. There's no sense in trying to guess when this is gonna stop. This week is traditionally has a bullish bias. December we could just rally until next year. I'm not getting crazy with the long positions. I lightened up today. I sold 2 positions, but at the same time I'm still heavily overweighted on the long side, and I think that's the only way to be positioned right now.